It takes us to our talk of the tape. Does the market have it right that the Fed can go big with its first easing move without sounding an alarm about the economy and with stocks not far from all-time highs? And would such a move be right on time or maybe a bit too late? Let's ask Wharton School professor Jeremy Siegel. But first, Professor, great to have you here. I do want to first have you listen to what hedge fund giant John Paulson said. He spoke with my colleague Sarah Eisen in a rare interview this morning about what he thinks the Fed should do at next week's meeting.
Personally, I think the Fed is a little behind the curve. Rates are, 5.25 plus, and inflation's down to the 2.5% rate. So we have almost 3% real interest. So I think they've seen enough data that they can start bringing rates down. And I would suggest more aggressively would be better. So I'd be for a 50 basis point cut rather than 25.
Professor Siegel, what's your take on that and the Fed's calculus going into next week?
I agree 100%, but I don't think they will. I think that it would have to be a really bad retail sales report early next week for them to do 50. I agree. As you know, I've been for these aggressive cuts, but the deliberateness of Jay Powell is 25 basis points. One interesting thing, it is almost incredible. The Fed funds futures that reflects the June meeting next year, June 2025, is now trading at 3%.
Yeah.
That is actually more than 9 cuts under the current level. Now, I think there's risk premium in there, and I've done some taking out some of that risk premium. So I estimate that 7 cuts. And what's interesting about that is there are exactly 7 more meetings between next week and the June meeting of 2025. So actually a 25 basis point cut in each and every meeting would actually, bring us down to around 3.5 and 3 3/4. And, I've said that's where the funds rate should be. It should be between 3.5 and 4%.
Mm-hmm. Well, what's interesting about all that is, one, as you say, the market sometimes will kind of over-extrapolate or build in some kind of a what-if premium into the Fed funds futures. The other piece of it, though, is, and this is in the last day or two, where you had this Wall Street Journal article and an FT article kind of leaning in the direction of 50 basis points. These former Fed officials were giving voice to this idea that they could see the case for half percentage point move next week. And Loretta Mester, former Cleveland Fed president, has said as much, as did Bill Dudley, former New York Fed president, today. And it seemed to me that the market was willing to actually trade higher on that, in part because it seemed to lay the groundwork for half a point not being in response to outright weakness in the economy. In other words, we can have it all. We can have a resilient economy and get started on this easing cycle in a bigger way. Does that make any sense?
Yeah, it does. But, and I know Loretta, very well. Notice that phrase, a case could be made. She was really quite hawkish during, those early phases of Fed increases. So, that's certainly something that makes news. But I think there's a lot of could be mades. I think Austin Goolsbee is definitely making the case of let's be more aggressive. There will be a side on that. But I just don't think the PPI and CPI were just that good enough. Again, it would have to be a really horrible report. Don't forget, the real indicators are holding in at a moderate economy. I, say let's get down to where we should be as fast as possible. But what I think the market is saying, you know what? So it may be a few months longer before we get to where we have to be. But if by the middle of next year, we're 3.5% funds rate, hey, I'm good with that.